pretty poor start to the week and really flight to safety as we go into Monday.
Absolutely, Stephen. It started on Friday afternoon when Greece was downgraded by Fitch, and and it just reverberated really throughout the weekend, where Spain was also, the outlook there was changed from stable to negative, and we felt it really across the markets this morning, where we saw that even the manufacturing data that came out of China as well as the European zone this morning was not good, not showing a very good good picture at all. And we're just feeling those dead worries again coming out of the Eurozone. And also, of course, now there's the issues about the volcanic ash from Iceland. And we all remember very clearly the last time when that happened, a very big disruption to economic activity, flights being delayed, and I think that's also why we've seen the oil price retreat somewhat, and we've seen airline stocks all over the world also fall on the back foot there. So yeah, a very bleak start to the week.
Of course, a bleak May altogether, because since the beginning of May we've seen this continued pullback in the markets and really driven by those Eurozone debt problems. Would you expect this to continue in the short term, because May is seen as a weak month for the markets?
No, I think, this is a structural thing, Stephen. It's fundamental in its nature. If you have an overdraft, even, as a person with an overdraft, until that overdraft is paid, there's nothing you can do. You'll always be in the red. And it just goes to show that this is a reoccurring theme in Europe. And as much as sometimes during the year focus may shift to other countries and other areas or economic data that comes out, but it still persists, it still is there, and this is just a stark reminder of the fact that the European zone is still struggling, and it is being felt all over. For instance, in South Africa, Europe is our main trading partner. About 30% of our exports go to Europe, and that will obviously affect us, and we see that quite a bit in the emerging markets. That we've seen a big pullback also this month in May.
Of course, not very much on the economic calendar globally this week, so nothing else to really provide this market with direction.
Yeah, no, nothing much. It all seems to be secondary data. As I mentioned today, the manufacturing data I don't think there was much reaction to that specifically, more so than the status quo in Europe. The fact that the debt issues there still persist. So I think there's reaction to that. And looking to the rest of the week, there's some GDP numbers coming out of the United States on Thursday, and some also coming out of United Kingdom on Wednesday. And those are the only things really that are going to be perhaps something to look forward to this week. But I think we're going to be seeing a very red week this week.
And of course, lots of that economic data we've had out, particularly from the United States, has been quite soft. So last week we had the Mid-Atlantic Activity Index, we had the New York Fed Activity Index. Today we've got the Chicago Fed Activity Index. Most of those have seemed a little bit disappointing so far, so not really adding anything to those markets.
Absolutely. So it just really points that we're not expecting any kind of turnaround later on when the biggest market opens, the United States, later on this afternoon. So, there's just a regional, local data from Chicago coming out, as you mentioned. Last week you had other regions coming out. But look, we can only hope that something may happen tomorrow. Perhaps we'll see a turnaround Tuesday, so to speak. But, it's still, the time will tell, but it doesn't look good at all.
Well, just looking at the top 40 as we head into the afternoon, really only the gold shares doing anything decent. We've had that gold price going back above $1,500 an ounce. The rand, in the meantime, weakening to 7 rand against the dollar again. So good news for the gold miners.
Yes, absolutely. Better news today for the gold miners. As you mentioned, the dollar gold spot price went up quite significantly as a safe haven play for some traders out there, going into gold, US treasuries and the dollar. And but we've also seen a weakening in our currency also. So it bodes well for our gold miners, because it impacts the rand gold price. So therefore they will benefit from that. But only time will tell how long that will take before people move out of gold also to go into perhaps just US treasuries. But also gold is being supported by strong physical demand from India as part of the jewellery sales there.
The other end of the scale, we have Exxaro down quite sharply today. That company out with news this morning that is bidding $130 million for an Australian company called Territory Resources. And it looks like the market might think that it's overpaying for this acquisition.
Yeah, it's 64% premium. I think the market is reading that as overpaying, and they also mentioned that they do have other companies that they're seeing as potential targets. So I think the market thinking, the strategy of theirs to go into iron ore perhaps may turn out to be a little bit more expensive than they're willing to tolerate. So, but it's also classic, I think, acquirer versus acquiree, where we see people shorting the acquirer and longer the acquiree, because I understand territory was up quite a bit this morning in Australia. And I think, as you mentioned, at $130 tag price, it's quite hectic. But look, Exxaro seems to be quite convinced that there's been a structural shift in the price of iron ore since 2008, and they expect that to go on. So their plan is that they will be mining about 10 million, or producing about 10 million tons of iron ore within the next 10 years per annum. So, that does look good. It does bode well for the stock. But I think right now we're just seeing the classic acquirer versus acquirers and trading strategy.
Your view on that, though, do you think it's a good idea for Exxaro to be further diversified?
Yes, I think, diversification can only work well for any company. And going forward, they are going into, look, the demand from India and China from the steel producers for iron ore is immense. That has been very, very strong and persistently strong. So, I think that is a very good idea going forward. However, from the trading perspective, it's just overpaying. The cost of the strategy is what we're concerned about. And at a 64% premium, that's quite a hefty price to be paying for the assets, especially considering that there may be other assets that that they could purchase, and just overbidding for it is what our concern is at the moment. But yes, I do believe that it is a very good strategy for them to be going into.
Another share under pressure, African Bank Investments, has reported a 20% rise in first half profits. This share came under pressure a couple of weeks ago when it came out with that trading statement, because it looked like the market was looking for a much stronger rise in profits from Able.
Yeah, I think there was a report that came out that the analysts actually expected it to be about 30% higher in headline earnings per share for the full year, and at half year, 20% is not a bad showing, but I think, there's some concern that they may not be able to meet that 30% full year earnings increase. And look, dividends were also flat at, I believe, 85 cents per share. So not really, encouraging there. They increased their dividend cover to 1.6. But, I think a lot of analysts perhaps or a lot of traders slightly disappointed in the performance of Able today. And also for the first time we got to see the performance of Ellerines within that. They combined the Able banking unit and the Ellerines book there. So I think players got to see that a little bit, maybe a slight bit disappointed compared to what other furniture retailers have done, what Ellerines has done. But I think, if you look at it solely on their own, they have got a very good retail strategy. They have done well, but perhaps just falling short of analyst expectations. So we're seeing a pullback, a readjustment of that share price back to levels that they think are currently fair.